Hello, and welcome to the first Fin Know-How lesson on financial statements. This lesson is a part of a series of videos on financial statements, with this video being an introduction to the topic. I realize that for at least some of you, the thought of a numbers-heavy discussion on financial statements may not be particularly appealing. So we will spend time first to think about financial statements in conceptual terms. Because the focus will be on introduction and familiarization, I will skirt much of the detail and focus on the big picture. So many terms like accounts payable, or prepaid expenses, or cost of goods sold, or paid in capital that you will see in the slides will go undiscussed in this video. But rest assured, I'll come back to those in later lessons. So let's get started. Financial statements are like different views of a house. When you look to rent or buy a house, you will tend to ask to see the floor plan or the layout. You may ask for the view from the curb or a satellite view of the footprint and property layout and so on. Each of these views provide a different insight into what the house is like, but do not individually present a complete picture. The insights become a bit more developed when these views are reviewed together than in isolation. But even when they are viewed together, there's still only so much you can get to know about the house. It often takes a site visit or a walkthrough to get a more complete picture. Financial statements are analogous. The different financial statements, such as income statements or balance sheets, provide different views of the business. The perspectives get richer when they're viewed together. Still, the story is never complete with just the financial statements. This is why in business M&A, the acquirer will perform independent due diligence and kick the tires, if you will, of the business and not rely just on financial statements. As informative as the financial statements are, that is not to say that the financial statements have limited value. There is a lot you can learn about the business from them, how the business is organized, the business model it employs, how it operates, etc. It's just that you have to understand that it is a good perspective, but not a complete perspective. Okay? With this background, let's begin by looking at three main financial statements. The three commonly seen financial statements are the balance sheet, the income statement, and the statement of cash flows. The balance sheet is a snapshot of what a business owns and owes on a specific date. What it does is to list the business's assets, meaning what the business owns. It also lists the liabilities of the business, what the business owes third parties. And finally, it lists its net worth, also called its equity capital. If you think about a balance sheet in personal terms, your balance sheet today will tell you what you own today. It will list the assets you have, such as your home, your car, a cash in your bank account, your retirement account balance, and so on. It also records what you owe today, such as the balance on your mortgage, the car loan, the credit card debt, etc. The difference between what you own and what you owe today is your net worth today. Notice I've repeated the word today multiple times. I did this to emphasize the fact that the balance sheet provides a view of your financial situation as of a particular date. And in our example, that date was today. Notice also that your personal balance sheet said nothing about how much you earn or the cost of running your household, the taxes you pay, and so on. The business balance sheet is similar. It is similar in the sense that it provides information on what the business owns, its assets, and what it owes, its liabilities as of a particular date. Like in the case of the individual, the difference between the two, meaning the difference between the assets and its liabilities, provides the net worth of the business, also called owner's equity. And as in the case of your personal balance sheet, the business balance sheet does not state anything about earnings or costs or taxes. All it provides is the snapshot in time of what the business owns and what it owes. If you want to get a sense of what the business earns by deploying the assets it has on its balance sheet, you have to turn to a different financial statement called the income statement. The income statement is different from the balance sheet in its focus. The income statement focuses on operations, on how and with what resources the assets were put to work to generate profit. That's what it tries to convey. And it conveys that over a period of time. So think of it as a performance report showing revenue from the sale of its products and the expenses incurred to produce the product and sell it over a period of time. And that period of time may be a month, a quarter, or a year. In terms of a personal analogy, you may want to think about it like a tax return. Granted that it's not a perfect analogy, but still it focuses on what you earned and what expenses you incurred to earn that income and the taxes you paid and so on. So we've covered balance sheets and income statements, and that gets us to the third type of financial statement called the statement of cash flows. What the statement of cash flows does is to track the actual movement of cash in and out of the business. You may ask, well, didn't we do that already in the income statement? Why do we need a statement of cash flows? The reason why you need a statement of cash flows is not because the income statement does not capture the inflows and outflows of cash, but it's because of the particular way in which accountants record revenues and expenses. And that particular way is called accrual accounting. When accrual accounting is adopted, what you see on the income statement is not the movement of cash, it's a recording of the activity of the business in a time-aligned way. And we'll get into the details and specifics of accrual accounting and its implications later in the discussion. For now, the key thing to remember is that, like the income statement, the cash flow statement also tracks activities. It's different from the income statement in the sense that it focuses specifically on the cash outcomes of these activities. And it records that over a period of time. And like the income statement, and unlike the balance sheet, it is not at a point in time. So we have gone through a quick overview of the three financial statements. And now we're going to start taking a look at the formats of each of these financial statements. Since the focus is going to be on the format and not on the individual line items, you will see that I don't get into the details of individual line items. But again, like I said before, we will come back to that later in a future lesson. Okay, we'll start with the balance sheet. What you see in the balance sheet are two columns. And again, a reminder that balance sheet represents a snapshot at a point in time. There are two columns. On the left, you have the assets column, which is a column that lists all the things that the firm owns, what the firm owns. Okay. You will see things like cash. You will see things like inventory. You see things like fixed assets such as machinery, so on. There are many other items here too. You can see like accounts receivable or prepaid expenses, accumulated depreciation, and so on. And we'll come back to that later. But again, what you see on the left are the assets that the business owns. One other thing that I will call out here in the left column under the assets label is how those assets are listed. They are listed in the order of illiquidity. Put differently, the sooner or the more easily you can convert an asset into cash, the higher it'll be listed in this column. So for instance, cash sitting in a bank account is something that can be easily converted to cash that can be used to make a payment. So your deposits in a bank account is likely to show up at the top of the list under cash. At the other end of the spectrum, you will see fixed assets. Let's say you have a large piece of machinery. Those assets are not easy to sell, so you may not be able to convert it to cash at very short notice. So those kinds of assets will show up toward the bottom of the column within the asset side of the balance sheet. Okay. Again, the asset side of the balance sheet represents all the things that the firm owns, and they are presented in the order of illiquidity. The most liquid assets are toward the top of the column, and the least liquid assets are toward the bottom. And by liquidity, we mean the ease and the speed with which the asset can be converted to cash. Now we're going to move to the right-hand side. So you will see two boxes that I have created to highlight the two parts of the liabilities and equity side of the balance sheet. As you see, the liabilities and equity side is the right column of the balance sheet. The top box includes all things that the firm owes third parties. So if it owes a vendor, it's going to show up on the accounts payable side. If it has a long-term debt with a bank, that's also going to show up on the liability side. So everything that the firm owes is here. As in the case of assets, there is a particular order in which these assets are listed. And the way the assets are listed is by looking at how soon those liabilities become due. In this case, the payables to vendors are the liability that becomes due the soonest, so it shows up on the top of the list. Long-term debt, let's say a 5-year loan or a 10-year loan, are a long-term commitment, and in terms of how soon the payments have to be made, so it shows up at the bottom of the list. So this particular box between accounts payable and long-term debt represents the liability side of the right-hand column. The equity side, as you know, the label on top says liabilities plus equity. The bottom box on the right-hand column is the equity side of the balance sheet. So it's still on the right-hand column, but toward the bottom of the list. And the fact that it is at the bottom of the list makes sense because there is no commitment to pay equity holders tomorrow or the day after. They are residual claimants, as we discussed earlier. They get what's left over. And so they have the lowest priority, if you will, even though priority is perhaps not the right word. There is no, the time horizon to pay this commitment or to pay this investor is nowhere as high as the time horizon, nowhere as short as the time horizon over which a vendor may be demanding payment. Okay. So, and what is interesting here is that if you take all the assets and subtract out all the liabilities, you get what's called the shareholders' equity or the net worth of the firm. So the bottom box here on the right-hand column is your net worth. Right? Another way to put it is that if I add the liabilities and shareholders' equity, I should get the same amount as the total assets because that's how the balance sheet works. So everything that you own versus everything that you owe. So hopefully you have a sense, or rather the takeaway from this should be the balance sheet has two columns, assets on the left, liabilities and the equities on the right. The assets are listed with the most liquid assets on top and the least liquid assets at the bottom. On the right is the liabilities and equity column. All the liabilities are listed in the top part of the balance sheet of the liabilities and equity column, and the equity is towards the bottom. And within the column, the commitments that are due soonest go to the top of the list. Commitments that have the greatest amount of time to pay off show up at the bottom side, the bottom of the list. And then finally, you can what you own is a sum of what you owe plus the net worth or the shareholders' equity, and that is why the totals of the two sides have to equal. This is often called the golden rule of accounting, which is that total assets equals total liabilities plus equity. That takes us to the income statement. The income statement has this format where the sales, this is the revenue generated from the sale of the product, goods or services, show up at the top of the list. And then you start deducting out from that revenue all the costs you incur. Some of these costs are more direct, and for instance, the cost of goods sold represents the more direct component of the cost of creating the product. Towards the bottom side, you see more of the overhead expenses that make it possible not just to produce the goods, but also to take it to market. So for instance, the employee costs would show up here. The marketing costs and the selling costs would show up here. All the investment that has to be made to keep the technology up to date in the form of R&D show up here and so on. The difference between the sales revenue and all of these costs is called the operating profit or the income from operations. And from that, if you take out the interest expense on any debt you have and any taxes you owe, you get the net profit, otherwise called net income. Okay. Again, all the inflows less all the outflows is what gives you the net profit or the net income. And as you can see, there are many types of outflows. The more direct costs tend to show up at the higher on the list, and the more overhead type costs tend to show up lower on the list. That brings us to the third financial statement format. And by the way, when you going back to the income statement, as you can see, this is sales revenue and costs over a period of time, say from January 1st, 2024 to December 31st, 2024. Or it could be over the quarter that started January 1st, 2025 and ended March 31st, 2025. Similarly, in the case of the statement of cash flows, it is also over a period between X and Y. It could be January through December, or if it is an annual statement of cash flows, and if it's a quarterly statement of cash flows, it could be, say, from January through March. And the way the statement of cash flows is organized is when you start with the cash that you had at the beginning of the period. So let's say the beginning of the period was January 1st. So this is the cash you had on hand in January 1st. And over the year, and I'm going to assume that the time horizon is a year in this case, there is cash that you generate from your operations, and that becomes the cash receipts. The cash outflows or the cash disbursement is picked up next. And the difference between the two becomes a cash from operations, meaning the cash received as a result of the operation versus the cash disbursed as a result of the operation. The difference becomes cash from operations. The next line item you see is fixed asset purchases. Those are the outflows associated with the acquisition of heavy assets like plant or property or equipment. And typically these are represented on a net basis. So if it is positive, that means assets were purchased. If it is negative, it may mean that assets were sold, or vice versa, depending on how the statement is set up. Similarly, there's borrowings. If there is more money comes in, it's a positive flow into the business. And if it is the payoff of borrowings, it's an outflow from the business. Then there is income tax paid, and the last form of financing, it could be the sale of stock. So if more stock is sold and cash comes into the business, it becomes positive. If on the other hand, no cash comes into the business, but dividends are paid out, that may get recorded as a disbursement for a stock, I should say, it's a stock-related disbursement. So when you start with the beginning cash, add the cash that came from operations, take out the monies you spent net on buying capital equipment, add the cash that comes in because of net borrowings, take out the income taxes paid in the form of cash, then add the monies that come in from the sale of stock, you end up with the cash balance as of December. Remember, we started with the cash balance because in this example, we assumed a 1-year time horizon. You started with the cash balance at the beginning of the year. You had operations, fixed asset transactions, borrowings, income taxes, and the sale of stock. And when you adjust for all those things, what the cash you have left is the ending cash balance as of December for this company. So we have covered the format of the balance sheet. We have covered the format of the income statement, and we have covered the format of a cash flow statement. To get you a little better feel for how this plays out in the real world, I'm going to walk through the financial statements of a newly established business, trying to get you at least an initial but a more intuitive understanding of financial statements. So we're going to assume that the new business goes through the sequence of events that is typical of a new business: raising capital, acquiring assets, combining assets with resources to conduct operations and to generate profits. So the two forms of capital that we have discussed in the past are debt and equity. If the capital is raised in the form of debt, that will show up on the balance sheet in the liability side of the balance sheet. So if I can go back to that screen, it's going to show up. If it's short-term debt, it'll show up here. Long-term debt will show up here on the right-hand side of the balance sheet. If it is equity, it's going to show up here in this tab. Again, on the right-hand side of the balance sheet, but it's going to show towards the bottom in the shareholders' equities block of the liabilities plus inequity side of the balance sheet, meaning the right-hand side of the balance sheet. Now, when those monies that you have raised are deployed, they're going to be deployed to acquire various kinds of assets. That will show up here on the asset side of the balance sheet in the left-hand column. Um, so this is where the fundraising and the acquisition of assets of the new business get reflected first on the balance sheet. Then the assets are then deployed with various resources such as employees and software and so on. Those expenses are going to show up here in the income statement within the cost of, within, let's say, general and administrative expenses. Um, Now, also the sales revenue and the profit, meaning the sales revenue less costs, also show up on the income statement. This is because this, if you remember, this is a performance tracker. It shows what did you do with the assets you had. You combined it with various other resources, created a product, sold it to generate revenue. Then you track all the costs that enable you to create that product and get it to market. And that's what's picked up in the income statement. And then, as we noted before, because not all transactions are cash-based and you want to track the operating activities, the capital equipment, investment activities, raising of capital, all of that will show up in the statement of cash flows. So that is how the business activity gets picked up in the financial statements. So to recap, the balance sheet has all the assets that the business just acquired. It also has the liabilities or the commitments it has to third parties um, that is owed to these third parties, which is as part of the capital raising activity. It also has the owner's stake or the equity, which is all the equity capital that was raised to fund the business. The income statement reports the revenue from the sale of the product, less the expenses to determine what the profit or the net income was. And then on the statement of cash flows, we track three types of activities: the operating activities, which either generate profit, but also cause cash outflows or disbursement of cash. And you have the investment activities, where we are buying long-term equipment such as plant, machinery, and so on. And then there's financing activities also picked up in the statement of cash flows, whether it is from equity owners or equity providers or creditors. So we now have the three statements. Also, I would like to call your attention to the fact that these statements, while are different, and one represents a snapshot in time and the other two represent as activities over a period of time, it is helpful to understand that they are somewhat interconnected too. So for instance, if a business does well and generates profits, those profits may go to the balance sheet in the form of retained earnings. That is, if the profits are retained by the business. Um, on the other hand, the profits that are paid out to investors might show up on the statement of cash flows. And so the statement of cash flows then allows the balance sheet, or shows the connection between the cash on the balance sheet at the beginning of the period to the cash on the balance sheet at the end of the period by tracking all the inflows and outflows. So the statement of cash flows is linked to the balance sheet, or in other words, another way to think about it is the balance sheet at 2 points in time are can be explained through the statement of cash flows. Then in terms of the relationship between balance sheet and income statements, when the profit is generated from a business, or investments are made in assets, or capital is raised, um, these activities which, so for instance, capital raising is going to get reflected on the balance sheet, profit generation is going to show up on the income statement. But because the flow of cash from these two activities need to be recorded, they will show up in the statement of cash flows, and it will help explain the movement of cash from in and out of the business. So we've covered a bunch of new topics today. We have covered it at a high level to give you a sense of what a balance sheet might, or an income statement, or a statement of cash flow looks like, and what kind of information is recorded within them. I know it's a new topic to you, and you may have questions after you're done with this lesson. As always, if that is the case, please don't hesitate to reach out. We'll be happy to spend some time with you to um, go through the details of parts of this discussion, especially those parts that you have difficulty with. So with that, we'll wrap up the video for now. I thank you for your time and look forward to seeing you in the next lesson.